the, all right, and welcome everybody to the Option Pit webinar of the month. I am Mark Sebastian. I am the founder of this company. A little bit about me. I was a floor trader for, a little under a decade. I then have spent the last couple of years doing education, consulting, and trading for myself. So I've worked with individuals who are just learning to trade, and then I've worked with RIAs and hedge funds that have had into the billions of dollars. So I cast a wide net with what I've done and what I do. So hopefully, I'm going to try and pass down some of that knowledge that I have learned today about using volatility to trade directionally. All right. Try and save questions till the end unless they're extremely relevant to what I'm discussing at that moment. All right. So what are you going to learn? All right. We're going to really talk about how volatility can act like a headwind or a tailwind to successful trading. We're going to learn about basic buy-sell decisions to profit. We're going to talk about how strike selection can make the difference between a good trade and a bad trade. And I'm going to teach you a combination of buy versus sell and strike decisions that can really kind of pay off, in my opinion. So the key to understanding options for direction is to understand what correlation is. All right. Correlation means how investments move with one another. All right. So if two investment vehicles have a correlation of 1, then they will move together perfectly. All right. If the correlation, there can be correlations in stocks that are 3, 4, -3, -4. UVXY, for instance, I believe has a negative correlation to the SPY of something like -5 or something like that. It's ridiculous. Now, the correlation of an option to its underlying, for our intents and purposes, can never be greater than 1 or -1. All right, so an option at its most will correlate at 1 or -1 to the underlying. All right, this correlation is called delta. All right, delta is the option trader term for correlation. In math, it can also be called slope. Why do we call it delta? Well, scientists love Greek. Mathematicians love Greek. They're all big fans of Pythagoras. That would be a we would answer much more differently about your beautiful wife. Thank you, Dwayne. She is hot. I will give you that. My wife is super good looking. I am a lucky man in that respect. So the delta is the correlation of an option. Where can you find other correlations? There are places on the internet where you can get them. I don't have them, but there are places out there. It's typically called beta. So Yahoo Finance often has the beta to the market. So that's there. All right. So delta can change. No. Someone said, show us a picture of your wife. Really? Who asked that? Delta can change with the passage of time, change in price, or it can change with another picture. Or it can change with another important factor that we're going to talk about. All right, and that so delta correlation is a moving target. All right, and it can change with the passage of time and changes in the underlying price or this important factor. All right, that I'm going to get into, which is volatility. All right, delta can be described in many ways, but the one most commonly used is the correlation of an option to its underlying, as stated above. Thus, an option with a positive delta of 0.6, all right, perverts. A bunch of perverts here tonight. Options with a positive delta of 0.6 will make 60 cents for every dollar the underlying rallies. All right. It will lose 60 cents for every dollar the underlying falls. All right. Options with a negative delta will be the opposite. So, let's say I buy a call that has a delta of 0.6 or, 0.5, let's say. So if the underlying rally is 1 point, that call should make 50 cents. All right. If the underlying falls 1 point, that call should lose 50 cents. All right. Now, if I, let's say, buy a put, and puts have negative deltas, then I would buy a put with, a negative 0.5 delta. So that means if the underlying falls 1 point, you get negative times a negative. Negative 1 times negative 0.5, I make 50 cents. If the underlying rallies, I lose 50 cents. That is correlation. All right. Now, are we all able to hear me still? I just want to check. Someone's saying that there's no sound. All right. So, yeah, all right, good. What makes delta so hard relative to stocks is that it changes on the trader. All right. So delta is a moving target. It's not stationary like stock. You buy 100 shares of stock, you are long 100 deltas. All right. You buy a call that is a 50 delta, and at expiration, it has to either be a 100 delta and expire into the stock, or it has to be a 0 delta and go out worthless. So delta is a moving target. All right. So there are some drivers in change in delta that are easy to understand, like price movement and the passage of time. All right. The one that can have the greatest effect on the performance of a directional trade, in my opinion, is volatility. All right. Obviously, movement in the underlying is important, but volatility is far more important than many traders realize. All right. So has this happened to you? Mark, market makers are a bunch of cheaters. I bought all these calls right before earnings. The stock is way higher, but I'm not making any money. Market makers are taking my money. Does that sound familiar to anybody? I get that all the time. I really do. Well, let me show you. So we can look at Apple. All right, so this is Apple. All right, and so let's look at it. Earnings were Monday, so let's look at it right here. So here is Monday, right before earnings. All right, and let's say you said, Mark, I know Apple's going higher, and so I'm going to buy the November let's say the November 105 calls for $1.20. Or heck, we can even look at the October 105s. So look at both. So those are $1.20, and the October 105s are 46 cents. Well, now let's look the next day. All right. So Apple's up $2.71. Do you think the 105 calls are more or less expensive? Yeah, they're far less. Yeah, they're 10 cents. Right. How about the Nove? The Nove 105s are the same price, maybe down a little bit. Yeah, they're off like 3 cents. I mean, this is this type of stuff that will drive people mad. So here we are today, and those 105 calls. Here we are. The stock's now up over $5 from Monday's close, and the calls are still down. In October and in November, they'll be up in November, I'm sure. Yeah, see, they've almost doubled in November. And so that is, you have no idea how often people said, oh, they took my money. No, expectations changed. The belief of how much Apple is going to move changed. And also there's a supply and demand issue. All right? When people buy calls into earnings and then earnings come out, a bunch of people typically come in and try and sell calls. If 5 guys walk into the room with the same baseball card trying to sell it at the same time, do you think the price of that baseball card is going to be higher or is going to go higher or lower? It's going to go lower. Higher. No. So that's really the key. Is it Jeter? It's definitely going lower then. Yeah, flooding the market drives price down. That's what really drives volatility and drives option prices, is market. So now the Greeks, all right, delta, all right, they are a modeled risk, and this is the key. They're modeled risk based on inputs into the model. They are meant to help traders manage the risk of a given option position. All right, the Greeks are an output of a model. They are not a hard number. So think about this. All right, delta is an output based on a set of assumptions that get put in. All right, you ever heard the term garbage in, garbage out? If I put in a garbage volatility assumption, and the delta produced is going to be garbage. So that's actually the key here. So going back to our Apple example, take a look at the delta now of the 105 calls. See, they're assuming there's 17 delta. Now the next day, the delta is 10. All that underlying exposure got sucked out. All right. So if you have a bad vol number, or if your vol number is wrong or moves on you, your delta will move on you. One of the things I really like about live vol is they don't automatically move the vols. Like one of the things with Thinkorswim, right, or Options Express or some of the other ones, is that they constantly move their implied volatility with the underlying price. For live vol, I actually have to physically move my volatilities, so I can actually see the shifts in volatility. It's really a very useful thing for me. And it's good for teaching. All right, so now delta. Since delta can change and is modeled risk, picking the right option for the directional opinion is key. Should an option be bought or sold? Should it be bought in the money, at the money, or out of the money? It all depends on one thing, and that's implied volatility. Where is implied volatility? All right, so what makes trading stock volatility different than trading a stock itself? All right, over the long term, I know where a volatility will go over a long period of time. All right, we don't know where a stock price is going to go. Implied volatility is mean reverting, which means it goes back to a normal. It's median reverting, mean reverting, and mode reverting. So here's kind of a graph that I like to pull up of the stock of Apple. Doesn't look like there's a real mean there, does it? I mean, look at those things moving around. Now, look at that. Look at, this is VXAPL, which is the VIX of Apple. All right. And the VIX of Apple is a lot steadier. All right. It does mean revert. It goes back to a normal. Yes, it is being recorded. All right. So mean reversion. A stock can go anywhere and stay there. right? Like Apple's now above 1, is almost 105, all right? And I bet you if I go on a message board, I can find people that think Apple is never going to drop below 100 again. You guys think I can find that? For sure, right? That is the fanboy stock of the century. All right. Then you've got Apple volatility. Now, when Apple volatility hit 60 a couple years ago, I knew it was eventually going to come back to 25. When it hit 17 earlier in the summer, I knew it was eventually going to go back to 25. It will revert over time. Now, it can stay low for a while, especially index vol. But, you know, individual equity vol will revert pretty quickly generally. All right, so understanding this can help with buy-sell decisions. So buy-sell decisions. In general, when implied volatility is low, in the near term and especially in the long term. So when I've got, you know, one of the things we talk about in the VIX primer that we did last month is cycles of volatility. And there are really 4 main cycles of volatility, right? It's got depressed, normal low, normal high, and high, or panicking. All right, panic periods are typically short but extremely high. Depressed levels are typically longer and low, and then the other two are and the other two are, you know, a little bit take up a nice piece of the time. I would say that we get panic maybe 5% of the time, depressed 20% of the time, and the rest is taken up by medium high and medium low. All right, so when volatility is in that medium low range or that low range for the market and the stock itself is in a near-term low, buying options can make a lot of sense. All right, when implied vol is normal or high, all right, then it typically makes more sense to sell call or put spreads. Getting long. All right, so when you want to get long, you can sell puts or buy calls. Each acts differently despite being long exposure to the underlying. So a short put is long delta and short vega. Vega is kind of like an options delta to implied volatility. All right, so when you're short vega, you want volatility to drop. All right, so thus a trader's hoping the stock moves higher and implied volatility come in. Now, what makes implied volatility drop? All right, IB often drops because realized volatility drops. All right, it also drops because expectations of volatility drops. Thus, a short put is actually a play on lower market movement. All right, when selling a put, the trader is not actually betting on a rally. All right, you're actually betting on the underlying not going down. Okay. So here is AutoNation. And this was one that I really liked, and I actually wrote up an article on the street about this one. All right. Warren Buffett, you know, it had popped on a bunch of Warren Buffett news. The market was absolutely tanking. And I said to myself, you know, I think they're throwing out some baby with the bathwater. You can see implied volatility. This red line here was spiking. So what did I say to do? Sell a put spread. Here, I'll show you. Just to... One second, folks. Here you go. So this was the trade. It was just a no 46.44 put spread at 50 cents. And that was how I, and so yeah, I posted the trade. It was just too big of a layup. When they throw the baby out with the bathwater, and not only, so take a look at this. AutoNation, the vol had not been this high in the last 6 months. Actually, I looked, it was in a year. I mean, it was a pretty favorable risk reward on a put spread sale. Yeah, so it was a nice put spread there. Well, when vol gets that high, you don't even want a long hard delta. You want to sell some soft deltas. All right. So a long call, on the other hand, is a long delta and long vega play. All right. The trader is hoping the underlying goes up and implied volatility goes up and vol goes up. So what makes that happen? An increase in movement, an increase in expected movement. When you buy a call, you're expecting the market to rally. You're expecting the underlying to go up. It's not the same as expecting it not to go down, right? When you sell a put, it's kind of like being in a hockey game in the third period and you're up 2-1, right? You're more concerned with them not scoring a goal than you are with actually scoring a goal. All right? When you are long a call, it's kind of like being 0-0 in the third period, right? You're actually, or being down 0-1. You're more concerned with scoring than with stopping them from scoring. Does that make sense? I don't know if you know this, but I like hockey. So this is CF Industries, and this was one of the layups of the year. I mean, they just absolutely obliterated the implied volatility. And I'm looking at this thing, I'm saying, I think this thing's going higher. And so if you see where vol is, take a look at this, all right? So it drops and vol drops at the same time, right? It touches that 50-day moving average and starts to rally. At the same time, the implied volatility is basically at the low of the year. And look what happens. The stock absolutely blows up. Now, you got lucky there in how hard it blew up. But that was an absolute layup. All right, so now let's talk about getting short. All right. Like going long, when one is making buy-sell option decisions, one must take implied vol into account. When IV is high and one thinks the stock is going to go down, you sell calls. When IV is low and one thinks the stock is going to fall, you buy puts. Now, there's obviously a lot of nuance to this. I'm kind of leaving out any complex spread. So short calls, this was an SLV. All right, the implied vol is nice and high. And I'm sitting there saying, silver's just gonna either fall or it's certainly not going higher. And so a bunch of call spreads made a lot of sense as a sale. And you can see the stock just kind of slowly ground lower. And implied volatility did slowly drop. It was a nice sale. Now, this is one where a put made sense. Look at IYR. All right, so we've got the Fed coming up, and we've got tapering coming up, and all sorts of things. And so think about this. Like, we're all talking about the potential for Fed tapering, and the home building index is at an all-time high. Nobody thought, hey, that's a recipe for losing money on a sell-off. Shockingly. Does that make sense? No. So what did we look at? We looked at buying puts, And of course, that was another nice home run. When volatility hits these really extreme levels, where it's almost like pulling a rubber band, it snaps. It will snap. All right, so now let's talk about, so now we've talked about buying versus selling. Now let's talk about strike selection. We're going to talk about hard versus soft deltas. All right, so the next step is select the right strike. This is done based on the certainty of the next volatility move. All right, I'm going to explain what these are. When one believes that implied vol is going to go up, a softer delta makes sense. When one believes that implied volatility is going to be stable or go down, a harder delta makes sense. All right, and that's in terms of buying. All right. All right, so if you think, yeah, I mean that's always the case. Now in selling, it's the opposite, right? If I believe that implied volatility is going to go down, is going to go down, or if I think that the volatility is going to be stable or maybe drop, I might sell an option. I might sell a call spread. All right, and then when implied volatility is really low, I'm going to be looking to buy puts. All right. All right, so a hard delta is relatively resistant to change in volatility. All right. Those are going to be more in the money and somewhat at the money options. So we're talking 60 to 100 delta options are going to be harder deltas. Now a soft delta is going to be dependent. So those are going to be your out of the money options. All right. Understanding the difference can help with strike selection. So when would I use a hard delta? When do I want a hard delta? All right. When I'm not sure of implied vol's future movement. All right. When implied vol is really high, it sometimes makes sense to use a hard delta if you think it's and you're buying, you want to buy a call or a deep in the money call. Then that makes more sense when implied vol is high. All right, and when one isn't sure of the severity of the expected move but wants to have limited risk. All right, and that's on going long. All right, going long options. All right, you flip it if you're going short options. So here's Goldman Sachs, and this was one where I thought boy, that vol's really high. They just tanked the stock. I think it's going a lot high. I think it's going to rally pretty quickly. Two things I would do here is I'd either sell a put spread or I'd buy a slightly in the money call. So what I want to show you is the effect that volatility has on an option. So here we have two trades. All right, I can buy the December 110 calls, or I can buy the December 125 calls. All right, so now let's kind of, and you can see how they move later on. So I can buy one December 110 call for $7.60. That buys me 70 deltas. See, 69, 70 deltas. All right. Or I can buy 8 Goldman Sachs December 125 calls for 96 cents. So I'd spend $768. I get 130 deltas. All right. Now, let's take a look. A week later, it's up $5. I sell my Goldman Sachs 110 call at 1065. That's a profit of 305. That's for one call. Return of almost 50%. I sell my 8 125 calls at 119. That's a profit of only $184. Vol was high. The trade I wanted to do was to buy the in-the-money call. Now, what else could I have done here? Hey, how about like the 115 105 put spread at $3? That would have been, I could have done, that would have been about the same, and I make about the same, right? All right. So now let's look at some soft deltas. All right. Soft deltas are more sensitive to implied volatility changes. And there's some very specific times where they make a lot of sense. When implied volatility is really low, when there's a major move coming, and then on these cheap bets. All right. Most importantly is when implied volatility is exceedingly low. So this is IBM. Okay, yeah. All right. I was just making sure because I thought I took I did change it. All right, good. So this was back when they had that first major dip back in November of last year. All right, and I wanted to point out how low implied volatility got. All right, so now let's take a look at a hard versus soft delta. So on the 21st of November, I can buy a call for, I can buy an in-the-money 185 call for 680, or I can buy a few of the 195 calls for 122. You can see how they move later on. Notice these implied vols, right? The 185 calls go up in vol, and the 195 calls go up by somewhat significantly. So I spend 680 for one 185 call, or I can buy 5 of the 195 calls for $1.22, and I'm spending $610. All right. So now, 2 days later, I sell one call, the 185 call out at $2 at a $2.50 profit at 9:30. Not bad, right? I mean, $250, $250. But my 5 calls that I bought out of the money when vol was really low, I make almost 100% on my dollars. The soft delta was the far better play. If you thought IBM was going to go down, you buy puts. All right. So now here's a couple. I'm going to teach you guys a little trade that I do. So I actually, live vol gives me a bunch of vols that I look at regularly, and it keeps track of 52 and 104-week lows. And so what I do is I actually scan and look for those on a daily basis to find trades. And so when I see for you guys that maybe don't have live vol, the SIBO puts out VIX methodologies on a lot of different stocks and ETFs. There's VX APL, VX IBM, VXGS. VXGS, you name it. So what I like to do is I like the stock, when the stock hits a 52-week high and a VX index hits a 52-week low, I like to buy out of the money calls, and it is a relatively consistent winner within about a week. I typically have doubled my money on those, at least done 50%. Because stocks that hit 52-week highs typically hit more 52-week highs, But options that hit 52-week lows and 104-week lows typically do not keep doing that. Well, so somebody said, but the stock has to move up for soft ones to work. Well, the other option is, when volatilities get that low, you don't want to be selling. You can sell puts, but it's just not as favorable a trade if you think the underlying isn't going to go down, right? That's the more passive trade. And that's why this is on directional trading. So if I think IBM is going to go up and vol is in the toilet, I'm buying calls. If I think IBM is going up and volatility is somewhat high, I'm buying in the money calls or I'm selling puts or put spreads. All right. So then you've got, I typically will buy one about 30 to 60 days to expiration. All right. And here's an example of one I did in Goldman in March. It just got to, here's VXGS, it just got silly cheap. And I just bought calls and wrote them up. It was like the layup trade of the year. And hard and soft trades, so the question is what days to expiration are these hard and soft trades? A hard delta and a soft delta, it doesn't matter the days to expiration. All right. Now, the one thing to recognize is that the closer you get to expiration, the softer a soft delta will get and the harder a hard delta will get. All right, so now here's IBM. Now, I personally think IBM is done selling off. With the vol here, what trade do you think I should do here? What trade makes the most sense? Well, so the volatility is really high, right? It's still high. Take a look at this. It is pre-earnings high, and earnings are already out. So that is a high volatility. So I would be looking to do one of the following. All right. I'd want to sell soft deltas. So I'd want to sell puts. I'd want to sell like a put spread or at the money or out of the money puts. Or I want to buy a hard delta call. But this thing is now, the trade I really did was called a bearish broken wing butterfly. And, but that is this is not a call trade. I said sell puts. I actually went on TV and said I think selling puts into this makes some sense. The trade, just from normally vol for this guy, if you look at VX, a normal vol for this guy is in between 15 and 18, and the vol's 23. So it's high. So in summary, volatility reverts, implied volatility helps form positions. There are different types of delta, and this is the position sensitive to change in IV. So I want to let you know about a class that we're doing. On Saturday, November 8th, it's going to be recorded. Andrew and I are going to talk for about 3 hours. Andrew's going to do about an hour and a half of presenting. I'm going to do about an hour and a half presenting myself. All right? And it's going to be all directional trading. All right? And how to do it with options effectively. All right? Andrew's going to go through some intermediate and long-term strategies. All right? As well as basic spreading. And then I'm going to dig into some complex spreading. And some more day tradery trades. All right, that and it is $47 until Halloween. I'm jacking up the price to its full rate after that. All right. HTTP www.optionpit.com/dir primer. It's going to be a good time. And you know, we did a VIX primer. We got rave last week or last month, and we got rave reviews on that. Well, thank you. Andrew's pretty good himself, though. And his stuff with long-term trading is really good. We actually do consulting work for a bunch of RIAs and investors and really teach them how to build cover investment strategies. So Andrew's done some really cool stuff there. Do you have a trade alert service? Kind of. Yeah, Andrew Keene, my foot. No, Andrew Giovinazzi, who's my partner. Yeah. That and the other Andrew is not fit for carrying Andrew Giovinazzi's sheets. I'll tell you that, his trading sheets. I'll tell you that much. Yeah, I'll post a link here. Andrew Giovinazzi is the guy who taught me how to trade. So when people meet him, they say thank you. All right, now do we have questions? Yeah, we do a kind of a trade alert service. It's not we have what's called the strategy letter, and it is not a trade alert service, but is a idea generation where basically we want you to see how we trade and think and follow along with us and you know, things like that. The volatility course is still available. Yeah, it is. DIR Primer, it's not working? Oh, whoops. Well, that's not the right link. Whoops. All right, let me so thank you. I don't know how that happened, but I clicked on something wrong because it is supposed to be this guy. Huh. How long is the Saturday session? Can it be downloaded? Can we set up the actual trades? Yeah, it's going to be downloaded. It's absolutely downloaded. Downloaded. DIR Primer. That's weird. Oh, I'm sorry. It's DIR Primer. Duh. Well, that would be why. Sorry about that. It's going to be about, I think it'll be 1 hour and 15 to 1.5 hour sessions with about a 10-minute break in between. And we're going to record it. So, can you get the slides today? Sure. And I will put a recording of the webinar. Can volatility be used to help exit a credit spread prior to expiration? It certainly can. I mean, it can definitely tell you when you've sucked edge out and when you know, it's a less favorable trade. For sure. Do we need to sign up for some extra website or platform to get all the IV info we need? You shouldn't. I mean, LiveVol, I use LiveVol because that's my trading platform. But, you know, like I said, I pulled up those VX indexes specifically because those are absolutely publicly available. You can get them on TD Ameritrade. You can do whatever. And really, every option platform has some sort of implied vol that you can follow. Is my online? Maybe. We'll see. Dirtbag. I will email the link. But yeah, go to the website now. Get yourself signed up. Why not? All right, any other questions? Mark, how do strangles play into your vol course? That's really non-directional. So that in itself would be kind of its own course. This is going to be a little bit more, I'm going to talk probably about flies, broken wing flies, risk reversals, credit spreads, debit spreads, outrights, things like that. Will I be as fast talking trades on falling volatility as today? Yeah, but Andrew's a lot slower talker than I am. So you've got that. Do you do many post-earnings trades on falling volatility? Yeah, I actually like trading out of earnings better than I like trading into earnings. How do I scan for stocks like AN? That is a live vol scan. So what I'll do is I'll pull up. Well, AN was just one I'd been watching because I saw some unusual option activity and put it on my radar. All right, here it is. http://www.optionpit.com/events will take you there, as will www.optionpit.com/DIR Primer. Will you ever have a course on strangles and straddles? I'm not liking the other fancy plays, and I can't sell options nor want to use margin. I'm sure, but strangles and straddles are pretty margin intensive. Yeah, I'm looking forward to having you, class. It's going to be a good time. We go through that stuff a lot. Andrew and I trade a lot of straddles in the strategy letter and strangles and kind of iron condor-y type things. What do you think about trading Amazon tomorrow morning? I think it's going down. When will I have another boot camp? I will have another boot camp in December. If you want to sign up early, I do have the boot camp up. I will send you the recordings to the last boot camp as well for free so you can get a head start. That is $147. All right, any other questions, comments, thoughts? Please do. What do I cover in the boot camp? Really everything you need to know. So we start with kind of basic synthetics, get into the Greeks, then get into some directional trading, then a little bit on non-directional. When looking, it really doesn't matter the model as long as you're consistent. I believe the model here is a trinomial. How long is what? I thought the boot camp was 99 last time. Yeah, well, that was last time. It's more than that now. We did do a special, I think, for one group for like a week where we made it $97. That's not available right now. Will this class be available? Yeah, we're gonna. If you register, I'll send you the recordings, so you'll get to keep the recordings. Does at the money vol affect out of the money options more than skew? Well, out of the money options, that skew is a really important part of how they move around. So skew is actually trades in conjunction with vol. So they're saying skew is just how the vol, the out of the money is relative to at the money. But when vol comes in, everything comes in. If you get now, if you're buying something and vol comes in and skew is steep at the same time, you're going to get obliterated. Oh, that's our Option Pit Live service. And that comes out through the strategy letter. Can we work with LiveVol free platform, or is it better to get the higher grade? Well, the LiveVol X is actually, if you trade interactive, they clear interactive brokers. So basically, all I do is this is an interactive broker's account, and I get better rates from LiveVol, and I get this better front-end platform. The only difference is I can't trade futures. Doesn't Gamma? Yes, it does. You'll notice I did not talk about day trading here today. The question was, doesn't Gamma play a big part in option selection for day trading? Indeed. Patricia, email me that question. That's one I'll have to answer when I see how it opens tomorrow. Yeah, the chat room is a part of that Option Pit Live service. So if you get the Option Pit Live, you get the chat room and the strategy letter all into one. Your thoughts on IWM, Diamond, SPY, and QQQ tomorrow? How long do we have? I think Vol got a little overdone this morning. You know, I was talking with Henry Schwartz, Trade Alert, and we were talking about a straddle, and I said in VIX, and I said that thing looks too cheap. I think Vol's gotten a little overdone, and actually, if you go to the blog, I basically wrote that I think that next week's SPX straddle is too cheap. So we were up $35 today at one point, and I can buy an at-the-money straddle expiring next Friday for $34. That just doesn't seem wrong. That doesn't seem right. So I think there's some more movement coming. Chat room is open during market hours, and we keep a daily recording of the chat room open for that called the Pit Report, and that's about 45 minutes to an hour a day. So if you miss the chat room, we really run through what's going on in the strategy letter, talk about the trades we're going to add, and talk about the management during that specific period of time. We record that, and one can view it later. IV30 is lower than HV30 today. Does that seem weird? Yes, it does. That's why I think that Vol's too cheap. Do you think the market will enter a downtrend or still in a bull market? You know, I'm up in the air there. I really am up in the air on this. You know, I think we've got at a minimum, I think we've got one big last gasp up before we have any real downturn. All right, so I will take 2 more questions. Would I sell puts in Amazon in the AM? I have to see where it opens and where vol moves. ES is down 12. Well, you know what? It's been moving 10 points before and after the market and has meant nothing in the morning. Okay, so spreads are included in directional trading. I thought it was only buying calls and puts. Correct. Oh, great. I'm looking forward to it. All right. I promise you guys, you're going to like this webinar on the 8th. We do a really good job. For $47, you are not going to get a better, you're not going to get a better 3 hours of your time. All right, everybody. Thank you. I'll get this recording out sometime tonight or tomorrow morning. Talk to you guys soon. Remember, optionpit.com/events, optionpit.com/DIR Primer. Oh, by the way, these events come free if you're an Option Pit Live subscriber. So everybody who is a monthly subscriber gets this stuff for free. That is not on a trial. So you have that going for you too, which is nice. Everybody have a great day.